A coin toss. That's how observers were describing the odds ahead of the latest Bank of Canada interest rate decision. Experts were apparently evenly split between the central bank potentially maintaining or cutting their rate during this time of tariff-driven economic uncertainty. But ultimately, they opted to hold.
Today, Governing Council maintained the policy interest rate at 2.75% following 7 consecutive cuts.
That's Bank of Canada Governor Tiff Macklem at his latest news conference.
At this meeting, we decided to hold our policy interest rate unchanged as we gain more information about both the path forward for U.S. tariffs and their impacts.
Here to break down this latest decision is Scotiabank's chief economist, Jean-François Perrault. He'll give Armina Lagaya some context around why the Bank of Canada went this direction, what it might say about the state of the economy, take stock of where we are with the ever-evolving global tariffs, and much more. I'm Stephen Maurice, and this is Perspectives. Now, here's Armina Lagaya.
JF, welcome back to the show as always.
It's lovely to be on.
Well, so much has happened on the tariff and economic front since the last time you were here in March, but the outlook is still murky. But before we get you to unpack all of that, first, what was the main takeaway from the Bank of Canada's latest decision for you?
Well, the main takeaway is that the Bank of Canada is just confused as to where things are going to go, as everybody else is. And as a result of that, they kept their interest rate unchanged at 2.75 and have indicated that they're in watching mode, as we are, to potential developments on the tariff side. What might happen in the economy as a result of that, what might happen in inflation as a result of that, what might happen from a fiscal policy perspective in Canada as a result of changes that are going on. So they are very much in a world where uncertainty is the key factor for their consideration.
Even the predicted decision was uncertain. Typically, in the lead up to a decision, there seems to be some kind of consensus about whether it'll be a cut or a hold. But in this case, it was essentially a coin toss. So in your view, is this what you were expecting? Was this the right call?
I mean, it is what we were expecting. But as you indicated, it was a pretty close call. We weren't going into this with a tremendous amount of confidence that we were right side of that call. But it is as we expected, and for largely the reasons that we expected. They worry about inflation relative to where it's been the last couple of months. They worry about the impact of tariffs on inflation. They know that there's an impact on growth. How bad that impact on growth is a function of where things go. So for the moment, based on the information that they had, which is the same information that we had, they judged it wise to hold off for a bit, for a long time. We'll see, relative to a decision where they might have cut.
Mm-hmm. Maybe we can talk about the latest inflation data that was released on Tuesday, sort of giving us an indication of the impact of tariffs and counter tariffs in March. What did we see? What did we learn from that reading?
Well, inflation actually came down in March to some extent because of the unwinding of the GST rebate. So it wasn't anything kind of substantial in terms of driving inflation. So inflation was a little bit weaker than expected, but it's still significantly higher than where it was a couple of months ago. And we have not yet seen the impact of tariffs play out through the consumer price index in any meaningful way. So it's too early to see an impact of tariffs. We expect it to happen. How much remains to be seen. So, some folks can take a little bit of comfort from the fact that inflation had been a little bit weaker than expected in the most recent result, but that's largely for policy reasons. The GST rebate unwinding doesn't fundamentally change how people, at least how we think about inflation. And it didn't seem to fundamentally change how the Bank of Canada thought about inflation, where they continued to point to inflation being stronger than expected over the last several months, or certainly since their last decision.
So typically, the Bank of Canada, before making this decision, will make some sort of forecast based on the available data and make a decision. But with so much uncertainty, the central bank this time laid out 2 illustrative scenarios for the Canadian economy. Can you walk us through each of them?
Sure. And before we walk through that, it's just an extremely unusual situation for the Bank of Canada not to put out an actual forecast. I mean, one of the key communications vehicles that they have with Canadians is a monetary policy report and the forecasts that are embedded in that. They give a sense for people as to how the Bank of Canada thinks are going to evolve going forward. So you can maybe plan accordingly. I mean, it is the Bank of Canada. They have more economists there than anywhere else in the country. In principle, they know what's going on and they have a good bead of where things are going to go. So that's usually helpful information for people as they think about their own financial situation or their own business. So this time around, given the uncertainty, they decided to forego publishing an actual forecast and put out a couple of scenarios out of many, 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 many scenarios that they could have chosen. The governor was very explicit about that. We picked 2. We could have picked any number of scenarios apart from these 2. And the first scenario is basically one in which these trade uncertainties unwind over time. that effectively assumption is President Trump is negotiating for leverage. As he gets that, we return to, say, more of a business as usual case at some point in the future. The second alternative is a scenario where it's effectively a big trade war, that tariffs get worse, higher than in that first scenario. They're permanent. They cause a lot more damage. And, you get a much weaker economy as a result of that, and much higher inflation as a result of that. So one is you can put it maybe kind of in the optimistic range of scenarios, and the other is in the pessimistic range of scenarios. And again, the governor went to pains to explain, like, these are just illustrative. We're not basing policy on these things. We don't expect these scenarios to necessarily materialize as we've laid them out. Because in fact, even in relation to what's been announced over the last 2 weeks in the US, or last week, as these tariff positions change nearly constantly, those scenarios don't reflect the actual reality of the moment.
What is your thought on what the likely scenario is? Obviously, there's a lot of uncertainty, but do you agree with those two illustrative scenarios, or is it somewhere in between? What's your outlook for the Canadian economy in the coming months?
So we're publishing a forecast on Wednesday. So by the time this goes out, we'll publish a new forecast. We assume for forecasting purposes that whatever is announced is permanent. And that is certainly how President Trump has talked about his tariffs. So you need to make some assumptions in the context of a forecast. And critically, on the tariff side these days, is just about the most important assumption you can make. It's also very clear, though, that tariffs, as they are currently laid out, if they are permanent, are very damaging to its economic prospects. So we're hopeful that as the summer progresses, or as the next few months kind of materialize and the cost of those tariffs become evident to American households, to American businesses, they are to some extent now, but they haven't actually really been felt. Markets have voiced their perspective on that, that puts some pressure on the Trump administration to back off. So it's more of a hopeful scenario that as we progress and get into the second half of this year, that maybe you have, greater clarity on the tariff side. Maybe some of these things are unwound, and that you have a bit more clear sailing going forward. But that's not our forecast. Our forecast is they said they were going to do X, Y, and Z. We're assuming they do X, Y, and Z, and this stays there forever.
Wow. What is the probability of a severe recession in Canada?
Again, this sounds like a broken record, but it's a function of course, how the situation evolves from a trade policy perspective at the moment. So in contrast to the Bank of Canada, we actually have to make a call as to what we think is going to happen. So, of course, we make assumptions that tariffs are permanent as part of that. But as a result of our view, so permanent tariffs, uncertainty remaining elevated, commodity prices coming down as a result of all this stuff, equity markets responding in a negative way, we're unquestionably looking at weaker growth into 2026. We don't see a technical recession at this point in time because we think and we assume in our forecasts that there will be a fiscal policy response in Canada. That as growth weakens, as a new government is sworn in a few weeks now, that government will be mindful of the impact on growth and will listen to the bank governor who said, we are relying on fiscal policy to get us out of some of these challenges. So we have embedded into our forecast a small amount of fiscal stimulus that prevents recession in our forecast. Now, if that stimulus doesn't occur, then you're probably in recession. If the trade war amplifies, that's to say, countries retaliate against each other or retaliate against the Americans, or that these 10% tariffs that are temporarily in place go back up to the 20, 30, 40, 50, 80% that President Trump had rolled out on Liberation Day, then you're looking at a much steeper recession in the US, and with that, an almost certainty of a recession in Canada as well. So we're flirting with recession. The extent to which we trip into that depends on how policymakers here respond, and of course, how President Trump takes his trade policy going forward.
Maybe we could do a bit of a recap or a status check on tariffs. There's been so much announced, paused. It's frankly hard to keep track. I wonder if you could give us a walkthrough of what the current status is on tariffs in Canada at this point.
So thankfully, that hasn't really changed in the last few weeks. You might recall President Trump had Liberation Day, as he called it, on April 2nd, which was an expansion of his trade war to every country in the world. But that didn't result in any changes from a Canadian perspective or Mexican perspective, for that matter. So it's still 25% tariffs on vehicles, not auto parts, vehicles, and only that portion of which is not made in the US, 25% tariffs on steel and aluminum, that hasn't changed, 25% tariffs on exports of goods to the US that are not what we call CUSMA compliant, so free trade compliant, which basically most Canadian exports to the US will be CUSMA compliant, so it's not really a big deal. And then 10% on energy, oil and gas, and 10% on potash. There are threats of other tariffs to come. on lumber. Actually, no, sorry, there is lumber. He announced that last week as well. On pharmaceuticals, on copper, semiconductors, a range of other things. Some of those will impact Canada, some may not, if he actually goes forward with those. But that's the landscape for Canada right now. The landscape for the American side is much bleaker than on the Canadian side because President Trump is, of course, the one imposing tariffs, and they're now against everybody. So for the moment, there are the tariffs that I've just walked you through on Canada and Mexico into the US. There are tariffs for the next 90 days, tariffs of 10% on every other country, except for China, and all goods almost out of those countries except for China, where there's a tariff of 145% placed on most goods. At least that was the announcement late last week. That's been modified a little bit over the weekend, where there were some exemptions given to electronics exports from China into the US. So already a bit of a scaling back. And over the last couple of days, President Trump has indicated perhaps some willingness to rethink the auto tariffs that have been ruled out against everybody. So it's a very, very dynamic situation. But the upshot is that the tariffs, as they're currently laid out in Canada and the US, are much, much, much higher in the US and much more damaging in some sense in the US than they are to Canada, given how dramatic they've been rolled out. So the flip side of the Americans putting tariffs on everybody is that countries have reciprocated, retaliated. And that is certainly the case in Canada, where Prime Minister Carney now has been pretty deliberate in terms of how he's approached the tariffs. So put reciprocal tariffs on autos, retaliatory tariffs on autos, for instance, and a few other sectors. Our tariffs are reasonably low, and it's a reasonably muted response because there is, I think, a clear understanding that tariffs imposed on Canadian businesses hurt Canadian businesses. So it's striking this balance between sending a message to the Americans without causing undue harm in Canada. But there has been some targeted tariffs put in place against American imports into Canada that will last, I suspect, as long as the Americans have got tariffs on us.
Now, inflation in Canada, or in general, is going to depend on the pass-through of these higher costs that businesses are feeling to consumers. How much of this is already starting to show? And if not quite yet, when will we start to see that pass-through?
We should start to see it soon. Not much of it is showing in Canada. We know, however, that, say, for instance, an anticipation of tariffs on steel and aluminum, on copper, on various things has led to very significant increases in those prices over the last few months. So those are working themselves through the system to some extent, but we're not seeing any tangible evidence of tariffs per se driving inflation in the last report. We expect that to show up in the next few months, maybe a little bit more next month and months after that, as inventories get liquidated, for instance, on the auto side, and the new autos that are for sale reflect those tariffs, as the price of various things that we import from the US, which will be more expensive because of the tariffs that they've imposed on themselves, come back into Canada, as the effect of the exchange rate gets felt through. Realistically, you're looking probably about a year, maybe a little bit longer, for the full impact of tariffs to be felt in the Canadian economy from an inflation perspective.
How about the jobs market? What are we starting to see? We're hearing anecdotally about production being either scaled back or paused. What are we starting to see in terms of the fallout in the jobs market?
Well, we've seen a decline in jobs in last jobs report, about 30,000 jobs lost. It was following a couple of months of extremely strong job growth. So it's not overly concerning from that perspective, but it is clearly an indication that businesses are becoming more cautious. And we're seeing that across a broad range of businesses and a broad range of households. So it's not just businesses that are cautious about the operating environment, it is households at the same time. So when you look at surveys of consumer intention, business spending intentions, they are all extremely negative relative to where they were a few months ago. And this is true in Canada, it's true in the US, actually might even be more true in the US than in Canada. And that is translating into reduced spending on the part of households and businesses. And of course, the less household spends, the less opportunities there are for businesses in this environment. In addition to businesses being cautious on their own because they don't know what the rules of the game are going to be 2 weeks from now or 2 months from now. So it's understandable that you get this pullback in economic activity, slowdown in economic activity. And one of the ways in which we see this is businesses being much more cautious on the labor side and laying a few people off.
One issue that has been front of mind when discussing past decisions but didn't come up much this time is the housing market. I wonder if we could take the temperature of where the housing market is right now in Canada and what has been the impact of all of this.
I mean, uncertainty is no friend to the housing market. In fact, it's probably the most impacted sector right now, in part because a housing decision is a major purchase for a household, right? If you're unsure if you're going to have a job or not 6 months from now because of concerns about tariffs, Now, of course, most people will have a job 6 months from now, but still, there's this reason for folks to be worried. And if you're worried about the environment you're operating in, then that's not a great environment for you to make a major life purchase like a house is. So we've seen last couple of months a pretty significant slowdown in housing market activity because people are worried. They're unwilling to pull a trigger on and commit to a very major expenditure. At the same time, there's another kind of compounding factor on the housing market side, particularly for new construction, for new purchases, is the political situation in Canada, where both parties, the Conservatives and the Liberals at the federal level, have promised to eliminate the GST on homes, on new homes. Liberals for $1 million less, Conservatives are $1.3 million or less. And so in a sense, even if you were of a mind to buy a house and say, I'm not that worried about the way forward, if you're looking at a new place, you're better off waiting a few months until government's in place and has actually implemented that GST cut, 5%. And that's a meaningful savings on a new purchase. So there's this kind of perfect storm for the housing market to some extent for the next few weeks, next few months, depending on how the uncertainty evolves and who wins the election.
There's so much uncertainty on so many fronts, from the election to tariffs, global trade, et cetera. It is not an easy job for the Bank of Canada to be making these kinds of decisions. What is your outlook, or what do you expect for the Bank of Canada's upcoming decisions? Are you still expecting 2 cuts this year? Could there be a supersized cut depending on what happens on the tariff front? What is your expectations for the rest of the year?
We're expecting them to be very cautious. So currently, we think they don't change rates for the remainder of the year. Now, the balance of risks is that they are more likely to cut rates than raise rates relative to where we are now. But these assumptions you have to make about the operating environment are really important for how the Bank of Canada thinks about inflation. Do we get a spike in inflation as a result of tariffs? We haven't seen that yet, but do we get a significant one? And if so, that really limits the ability of the Bank of Canada to come in and support the economy as growth weakens, as the governor's made very clear in a number of speeches now. How do inflation expectations respond? We've already seen in Canada a significant pickup in inflation expectations by households, right? In the 4 to 5% range. In the US, you're talking about 6% range. That is, say, people's expectation of inflation over the next 12 months. And those tariffs haven't kicked in yet. So that, from our perspective, puts a lot of pressure on the Bank of Canada to get it right on the inflation side, because the background here is the last time we had an inflation scare in Canada was during the pandemic, or the quarters coming out of the pandemic, where central banks made a little bit of a mistake. They assumed that the spike in inflation was going to be temporary. They communicated that they thought it was going to be temporary and acted as if it was going to be temporary. It ended up not being all that temporary, and inflation rose very significantly. And in Canada, the bank had to raise rates to 5% to bring inflation back under control. So it's a little bit awkward for the next inflation scare, immediately following the previous one, where you got a little bit of a similar dynamic of, we're not sure where inflation is going to go. We don't know how permanent or temporary it's going to be. We don't really understand the world in which we're operating in. So from our perspective, that means the bank's got to be a little more cautious about how to interpret either the growth numbers or the inflation numbers, given loss of credibility that occurred just a few years ago, the last time around.
Mm-hmm, for sure. So with all of this, what do you think are the main takeaways for Canadians from the decision, but also the outlook that the Bank of Canada laid out?
I don't think there's anything comforting in today. Sure, we got our forecast right. The Bank of Canada didn't cut. Great. But they're just as confused as everybody else. So to the extent that folks look to the Bank of Canada as guidance as to what to expect, how to plan their lives on the basis of, what Governor Macklem and his colleagues believe, they're telling everybody, we're just as confused as you are. We don't know what's going to happen in the US. We don't know what's going to happen with inflation. We're not sure what's going to happen to growth in Canada. So we are not able to provide you the guidance that we normally provide you. And that's not a great message. Unfortunately, it's the reality of the situation that we're in, and that's how markets are trading on the basis of this uncertainty. It's how we think about it when we put together a forecast. So there is that high level message of they are feeling the same kind of challenges and thinking about the world in which we're all operating in as we all are. But then again, it's also clear that we are looking at weaker growth than otherwise would have been the case. It's a matter of how much weaker, depending on how these things play out. But there's no question that the governor has indicated, and which is what we've been thinking for quite a while now, and others as well, that growth is slowing, and there's plenty of evidence that growth is slowing, and that slowdown in growth risks being meaningful for a few months to a few quarters, depending again on how the tariff situation evolves. So a lot of uncertainty about the way forward, but not much uncertainty that we're looking at a weaker environment than we were looking at a few months ago. It's just a matter of how much weaker is that environment and how much inflation do we get coming out of that environment.
Thank you, JF, for coming on to the podcast again to help unpack all of this.
Thanks, Armina.
I've been speaking with Jean-François Perrault, the chief economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.